An explanation of how the stock market functions. What is a stock exchange and how exactly does it function? The stock exchange is nothing more than a massive worldwide network that helps manage the marketplace, which sees daily transactions involving enormous amounts of money. Over 60 trillion euros worth of goods and services are exchanged each year, more than the total worth of all the products and services produced by the whole planet's economy. On the other hand, apples and used toothbrushes are not the goods exchanged in this marketplace. However, most of the time, securities. Securities are rights to assets and are most often issued in the form of shares. A share is the same thing as having ownership in a corporation. But why does stock trading ever take place? First things first, the value of a share is directly related to the firm that it is invested in. If you consider the worth of a firm to be comparable to that of a pizza, then when the overall size of the pizza is more prominent, each slice will be larger as well. Consider the case of Facebook, which, using a novel approach to doing business, might significantly boost the amount of money it brings in. The quantity of pizza produced by the company will also expand, leading to a rise in the overall value of the company's stock. The company's shareholders will undoubtedly find this to be quite beneficial. A steak that may be used to be worth 38 euros, but is now worth all of the 50 euros, is said to have increased in value. When it is finally sold, this will result in a gain of 12 euros for each share. However, what benefits does Facebook see from this? The sale of corporate shares allows the firm to generate more capital, which it may use to make investments or grow the business. For instance, Facebook has amassed $16 billion in revenue due to its listing on the stock exchange. The buying and selling of stock, on the other hand, is often like more than a game of luck. Nobody can accurately predict which business will have a successful year and which will not. Investors are more likely to support a firm that has a strong reputation. It will be tough to sell shares if in a firm that has a negative reputation, and much more difficult to perform poorly. On the stock exchange, as opposed to a traditional market where wares may be handled and carried home, only virtual products are available for purchase. They are shown on the displays in the form of share prices and tables. Share values like this may go up or down in seconds. Therefore, shareholders must take rapid action to avoid missing an opportunity. Regardless of the actual worth of the firm, the demand for a share might drop precipitously as a consequence of anything as little as a rumor. The inverse is also a possibility if a vast number of individuals acquire shares of a struggling company. Because, for instance, if they sense that a concept has a lot of untapped potentials, as a direct consequence of this, their value will increase. This is something that may be very helpful to younger organizations. Even if companies are experiencing a decline in sales, they still can create cash by putting their shares. The best case scenario is that this will lead to their concept becoming a real-world reality. The worst that may happen is that this would result in a speculative bubble that is nothing more than hot air. In the same way, as bubbles eventually pop, these bubbles will also pop at some time. The DAX share index summarizes the combined market capitalization of Germany's 30 most valuable corporations. The performance of these crucial firms, and therefore the economy as a whole, may be measured by how well or poorly the DAX is doing. The stock exchanges of other nations each have their own sets of benchmarks to measure performance, and the combination of all of these marketplaces results in a globally interconnected marketplace. The stock market is reliable for any nation's overall economic health. A country's growth is aided by expanding its commercial and industrial sectors. From this perspective, the significance of the stock market is enormous. There is no viable alternative to the stock market for fostering economic vitality and strength in a nation. The following are some of the reasons why the stock market is so important. The formation of capital. One of the most critical roles in forming capital for industries. While banks and other financial organizations contribute to the formation of money, the stock market is essential for collecting large amounts of capital over the long term. Inspiring savings. Individuals are motivated to cut down on their present spending and are inspired to raise their savings when participating in stock markets. Individuals and, by extension, whole industries stand to gain from implementing this solution. The mobility of resources contributes to the economy's vitality by facilitating the efficient transfer of resources from private homes to commercial enterprises. The accumulation of resources is one of the essential preconditions for the economic growth of any nation. Help helping in industrialization, contributing to the industrialization. The stock market supplies the appropriate amount of money for the various sectors. By issuing shares or selling debentures on the stock market, the company may quickly gather the required cash and use it toward business expansion. Improving living standards. Increasing people's level of life makes for more appealing investment opportunities for the general populace. Putting money in the stock market might be a simple way to make money. Therefore, participation in the stock market increases the general population's quality of life. Strong economic base. This facilitates the industrialization process by reducing the mobilization of resources. As a result, it contributes to a robust economy. The industry's expansion is necessary for a strong economy, and the stock market plays an essential role in this area. Safety of investment. This ensures the safety of the investment. The stock exchange maintains rules and regulations to protect the market from fraudulent activity. Proper valuation of share and security. It has specific guidelines for the value of stocks and securities. It broadcasts daily transactions, and investors may use this information to keep track of the price of shares and other assets in the market. Ready market. The stock exchange is prepared in both a primary and secondary market. In the same way that one may buy and sell things and services on the market, one can also purchase and sell financial instruments on the stock market. The stock market is nearly entirely focused on the trading of financial products. Proper utilization of savings. Usage of funds in an optimal manner. Stock market participation contributes to the optimal utilization of savings familiar people hold. It results in cost savings and generates money for the firms, and as a result, it puts those cost savings to good use. After all, the stock market is an important institution in the economic system. It is the interest of the firms and the investors who stand to gain from the transaction. It addresses issues of critical significance to the growth of each nation's economy. I hope you liked and learned something from today's video. If you want to keep improving and being inspired, subscribe and press the bell button to be alerted whenever we upload a video. This has been Market Profits Institute.